30-year Treasury yields just spiked to a level we haven't seen before the 2008 financial crisis, greatly affecting the credit capacity of new and old borrowers. But how? Also, Kevin Warsh has officially taken over as the new Fed chair amidst intense political pressure and sticky inflation. Lastly, a brand new app for Trump accounts is dropping this Thursday that is offering $1,000 in federal seed money to jumpstart investment accounts for the next generation. I'm Matthew White, along with my co-host Nyamki Buchanan, and this is Road to Riches. Welcome back, everyone. Glad to be with you again. Let's jump right in to the first article here, where we talk about the return of the 5% Treasury. And this article essentially goes over this article from CNBC goes over how the 30-year U.S. Treasury bond has just spiked past 5.19%. And as indicated by the intro or mentioned in the intro, this is a level that we haven't seen in almost 18 years. The 10-year is also hovering high around 4.6 to 4.7%. And traders are now pricing in fears of another rate hike before the end of the year. And this is due to sticky inflation numbers that are, of course, driven by the energy prices. Once again, we're looking at that consumer price index, or CPI. So again, right now, inflation is sticky with that CPI at 3.8%. Year over year. And again, it's driven by these oil costs. The Strait of Hormuz it's somewhat opening up, and oil has dipped down a little bit because traders are expecting a deal to come soon. They have gone down a little bit. However, they still remain pretty high because the strait is still largely closed or hindered. And so anyway, we're talking about what this means for the return of the 5% Treasury. And this is a game of, whether you're catching or you're pitching. For new borrowers, old borrowers, this kind of means that rates aren't going anywhere anytime soon. That 6.75% prime, that sounds like it's going to stay where it is. It may even go up to 7%. It just is what it is, because of these higher energy prices that we haven't seen since the president came into office. And so that's what that means for new borrowers, is that of course rates are going to remain high. But as far as savers, people who are contributing their funds for the banks to actually loan their money out, this is actually a mixed bag for them, because on the one hand, of course, they don't want to see rates high, but on the other hand, they kind of do, because it means they're going to get a higher rate on their savings, or it also means that they're going to continue receiving the high rate that they've been earning. And so again, mortgage rates continue to be somewhat high, credit card debt, things of that nature. But again, these high yield savings and CD accounts, money market, what have you, they remain high in interest. And as far as what all this means, again, this means that this is a big environment for saving. And in my opinion, I think that there's a big opportunity here to just sit back and continue putting your money in savings accounts, continue to hunt for whoever is going to give you the highest rate on your money, because these are conditions that savers haven't seen again since the '08 financial crisis. Um, Nyanki, what are your thoughts on what I'm choosing to call the return of the 5% Treasury rate, and what are the implications behind that?
Yeah, I mean, I tend to agree with you when you talk about how this is a good thing for savers. Of course, having those higher rates is going to be a good thing. Of course, when it comes to CDs, savings accounts, things like that, your bonds, of course, you're going to be seeing higher yields. And assuming that a rate hike does come, raising interest rates a quarter point, then some of that is going to get passed on, and we should then see a little bit of higher yields in those accounts. That said, I, I tend to take a little bit of the opposite stance when it comes to the possibility of a rate hike itself. The reason why I say that is because although inflation is increasing somewhat all around, the vast majority of that is due to energy prices. When you look at the CPI, they talk about core CPI, which is going to take out energy prices and a couple of other things. And that rate is not as high as I believe it was like 3.8 or 3.38, something like that percent, that the overall CPI rose. So with that in mind, we're seeing these or the spike in energy costs essentially trickle down into other areas. I mean, we've talked previously about how plane tickets and travel is significantly more expensive due to the war in Iran, and hopefully, as you said, the Strait of Hormuz does continue to open up a little bit. I know right now a few ships are flowing back and forth, but at this point, as of recording, there has not been a complete deal put in place between President Donald Trump and the Ayatollah of Iran, but so that is supposedly on the table. So we can hope, in the near future that that does get taken care of, which will then, of course, start to bring energy prices down a little bit further. But like you said, that optimism is somewhat priced in. I mean, around me, in the last 4 or 5 days or so, gas prices have gone down about 30 cents. So I hope that that continues,
Right.
because
Yeah.
I'm tired of paying an extra 15, 16, 20 plus dollars for gas. And then, like I said, of course, that's going to, trickle down to other areas. Um, Airlines, they're paying more for gas. Your grocery stores, they're paying more for gas to ship the goods to warehouses and into the stores, things like that. All of these methods of transportation, these uses of oil, are of course raising the prices of everyday goods and services for us. So um, these trickle down effects will be a good thing. And because of that, since the inflation is largely hinging on that one thing, those energy prices. That's why I don't necessarily think uh, that raising interest rates will be a good idea. They may still choose to do it. Of course, the Fed chairs are much more smart than me, much smarter people with longer careers, significantly more experience. But in my opinion, I don't necessarily think that at this time or even in the next couple of weeks, at the next meeting, for example, I don't think that raising rates is going to truly be beneficial to any of us. That said, of course, there are still second order effects to these interest rates staying high. As you said, savers are going to benefit, but on the other hand, people that are looking to buy assets right now are going to be, they're going to see the effects in the opposite way. They're going to be stressing out a little bit more. Mortgage rates are still high right now. For businesses that are looking for loans, those rates are higher right now. Individuals who are looking for car loans, personal loans, things like that, those rates are going to continue to be a little bit higher for at least another month or two. Generally, those interest rates don't fluctuate too much between times the Fed alters rates or not. So, like I said, at least for the foreseeable future, then people that are looking to spend money are going to be hurting a little bit more. People who are looking to save money are going to be benefiting a little bit more. But you know, that's just how the Fed was working, really under Jerome Powell, and now with Kevin Warsh being sworn in as the new chairman, things may change a little bit. Our second story here goes to talk about it a little bit. Let me get the screen share going. Kevin Warsh sworn in as Fed chair, a pivotal moment for the U.S. economy. Um, you know, really, the job of the Fed chair is the same no matter who's in the seat, right? They're supposed to oversee the other presidents and essentially kind of be more or less a tiebreaker or voice of reason. They have a position very similar, in my opinion, to the vice president in the Senate, right? So they have a lot of individual influence, but in order to keep things fair and balanced, they try not to, or at least should not try to get heavily involved in too many things. Though they do tend to be the face of the Federal Open Market Committee. Um, some things that we're seeing here. It says, "I expect he will go down as one of the truly great chairmen of the Federal Reserve that we've ever had. I really believe that." This is a quote from President Donald Trump. To me, of course, this signals that he thinks and hopes that Kevin is going to play ball a little bit with some of the things that Trump wants to enact or put in place. Personally, I really couldn't care less what the president's agenda is when it comes to the Fed, because we have people that are in these positions for a reason. Their job is to do what is best for the economy, and whether the president now, or 3 years from now, we'll have a different president at that point, thinks or says or wants. The job remains the same. The information is going to be the same. The implications are going to be the same for the changes. So we need someone that is going to be, in my opinion, very steady in their beliefs, and hold fast to that, much like Jerome Powell was in the last few months of his term. So if we can continue that type of a trend, I think we'll be in a good position with Kevin Warsh. Reading just a little bit further, and then I'll hand it over to you, Matt. It does talk in here a little bit about how it says, handpicked by Trump in January when expectations pointed to stabilizing growth and cooler inflation. Warsh now takes the reins of an economy that is shifting under the weight of the U.S. Israeli war with Iran. The oil shock has sharply pushed up gasoline prices, mortgage rates have climbed to their highest level in 9 months, and overall inflation has surged to the highest level in 3 years. These are some of the immediate problems that Kevin Warsh is going to have to address. There may be no change in policy. There may be a slight change in policy. There may be a significant change in policy. But of course, everyone's mind is on these issues here. And, I'm excited to see what the next step is as Kevin Warsh begins to go into his first committee. How about you, Matt?
Uh, yeah, so I am too. I'm interested in seeing how Warsh tackles the essentially the economic climate that we're in right now. If he decides that lower rates are the answer, or if there's a target range that he wants to be within. Um, or will at least advocate for as Fed chair. Of course, he may be the chair, but he's not the only voice. But there is one thing that he said, um, that was interesting to me, and it just paraphrasing here, but it sounded like he blamed the low rate policies post pandemic, for the massive inflation spike of 21 and 22, uh, which is something which is an interesting point, because again, a lot of people um, uh, may not specifically remember. Of course, a lot of us do, but some of us may not. Of course, the world was on lockdown at that time. There were certain mayors around the country were just now lifting mask mandates in 2021. and people were, of course, allowed to go back to work, but there were masks everywhere. It was not necessarily a very sociable time to be alive, that to say the least. And but all of that being said, what I wanted to point out was at least people were going to work. At least the economy was somewhat going in the right direction post pandemic. But then we get the low rates of 21 and 22, and all of a sudden money becomes extremely cheap in terms of borrowing it, and it becomes essentially worthless to save. It When rates are low, it becomes very cheap for borrowers and very expensive for savers, because savers are actually losing money because of high inflation, and that high inflation is caused by extremely low rates because it's very cheap to borrow. And so what I thought of when Warsh made that statement is it's extremely similar to my personal thoughts on the ups and downs uh, before major recessions and depressions in United States history. Once again, rates were extremely low in the mid 1920s, going up to 1929, where we had a brief recession in March of 1929, and then, of course, Black Tuesday in 1929, in September. And the exact same thing happened in 2004 and 2005, leading up to 2008. In fact, it was so bad at that time that people weren't even having to work, because they were simply just refinancing their house over and over and over again, because they increased in value so much, because rates were so low, money was so cheap, and of course inflation was everywhere. And so that's why I thought that statement from Warsh was interesting, is because he may have a point. There were other things happening during COVID. It wasn't, um, of course, we had the stimulus checks. It's never good to print several trillion dollars and just release it into the economy. That's going to be very bad for inflation. But again, the low rate certainly didn't help. It's one thing to have several trillion new dollars in the economy, but it's a whole nother level when you have several trillion new dollars in the economy and it's cheap to borrow. And so, he may be onto something there, and that may be a clue as to how he plans on managing the Fed moving forward. Again, we may not ever see 3.5, 4% rates ever again. He may plan to keep it between 5 and 7%, which has historically been the interest rate set by the Fed for the majority of the last 112 years it's been in operation. Um, and so that may be a clue into how he plans on running the Fed. Um, and there was another thing where he thinks that we can lean on AI driven productivity to allow the economy to grow without perhaps triggering inflation, and bringing about inflation because of AI. And as somebody who uses AI a lot, I have news for these AI enthusiasts. Now, again, this is coming from somebody who loves AI. I think that AI is fantastic. I think it's the greatest thing since the invention of the internet. So take this from somebody who genuinely loves the technology. It's actually not as good as people think it is. Uh, If you actually use AI a lot, and not just here and there, you ask it a question and it happens to be correct. If you use it a lot for work, for school, for your own personal projects, you will start to notice that AI still has a huge problem with malfunctions and hallucinations, and also has a problem with subjectivity and objectivity. A lot of the time, AI will just tell you whatever it is that you want it to. It'll it'll just agree with you for the sake of agreeing with you, even though you may be wrong. And it's getting a little bit better. For example, I use Gemini a lot. I use Claude as well, but I use Gemini a lot, and Gemini is getting better at not just agreeing with you, but also kind of addressing the other side of the argument, and how you may be wrong. Now, again, if you're right, you're right. And if you're wrong, you're wrong. But sometimes you are legitimately wrong and AI will still agree with you. Um, and and so, I just wanted to throw that out there. I think people think AI is better than it actually is, and I think these people are the ones who don't use AI all that much. We kind of saw this. We kind of saw that with companies having to, uh, of course, firing their workforces and then saying, "Oh crap," and then rehiring them when they realized that AI wasn't as good as they thought it was, or was extremely expensive and extremely inefficient at the same time. And will it get better? Absolutely, in the future, sure. But we're starting to see cracks and holes in AI, um, uh, and there's serious issues with it, and it can get better. We can continually improve upon it, but I don't think that um, it's what people is what those less initiated think it is. But all of that aside, I think Kevin Warsh has a bright future ahead of him. Obviously, a very um, accomplished individual. He has served on governor boards before. He's very familiar with how the Fed operates and the internal levers to pull, as it were. And so we will just wait and see what happens. I personally speaking, judging off of what I've seen so far, I think he may be set on lowering rates a little bit, but does not want rates to get below 5%, just because that's when you get into the territory of cheap money and higher chance for runaway inflation, like we saw in the years post COVID, even all the way up to 2024, mind you.
Yeah, I mean, there was definitely a reason for having money be cheap at that time. We did want to stimulate the economy. But as you said, I mean, historically, rates have been somewhere between that 5 and 7% mark. And most people don't actually know that. It's been a historic trend that mortgages have tend to be around 7%. So while we may say, oh, well, now, oh, mortgages are expensive, the interest rates are so high, it's hard to borrow money. Well, that's number one, it's for a reason, a very good reason, and it's to make sure that inflation doesn't run rampant. But number two, looking back on history, that's not really odd or out of the ordinary. Of course, we like to say, back when COVID was happening, people were getting 2 and 3% mortgages. That was also very odd. That hardly ever
Right.
happens. But even before then, we had been enjoying probably a decade of mortgages somewhere between 4 and 6%, depending on the amount in risk.
Well, I
So
think, sorry, what I was going to say is I think it's an issue of people. I think it's an issue of people not really thinking about the consequences of these actions. If, look, we all want money to be cheap. We all want we hell. I want negative interest rate. Give me negative interest rate like we had during COVID, which did happen. There were negative interest rates. Give me a 1% more, 3.5%. I'll take that all day. but the reality of that situation is what happens, what will be the consequence of you making money this cheap to borrow? What is going to be the consequence? What happens, for example, we'll use the post-COVID era. And by the way, Nyanki, let's talk about the current housing situation we're in right now. What happens when you make mortgages so incredibly cheap that you can just get a mortgage for 3.5%, sit on it for as long as you can, and now you get a situation in the year of our Lord 2026 where rates are rate prime is 6.75, and nobody can buy a house because they're extremely inflated. The values are inflated because the people sitting on them aren't looking to sell them anytime soon because their mortgage is 3.5%. Why would I sell it? And you get a situation where there's 635,000 more buyers than sellers in the housing market. These are the things that happen. These are the things that you kind of have to think about. Is uh, again, like you just said, when you make money cheap, um, yeah, it's great for the borrower, but in the long run, heck, even in the semi short run, you're going to find that it just makes everything more expensive, including the items that are being borrowed to purchase. I mean, even used cars were going somewhat of an oddity during COVID when they were more expensive than new cars. Some used cars were legitimately more expensive than used cars because money was simply so cheap to borrow, and people bought a lot of used cars. And it's and also new cars were kind of again, it was COVID, so new cars weren't exactly being produced like they are right now. And so, these are the things that I think a lot of people get stuck on. They come out strong. They're like, we want to help the economy. Okay, well, let's think this through. What is this actually going to help the economy, or is it just going to make things worse? Is it a short-term solution for a very complex issue?
Exactly. Yeah. So you've pretty much said everything I had to say on that one.
Well,
All right.
I try.
No, it's fine. It's fine. All right, we've got one last story here. Let me. All right. So about these Trump saving accounts for children. He's talked about this for a little while now. It was one of his large things that he kept bringing up on the campaign trail, and now we're seeing that this is finally actually happening. Right, the app for Trump accounts will launch Thursday. Here's what to know. You go down here a little bit. We're going to get to the part that I actually want to talk about right up front. Families won't be able to fund the accounts until July 4th when they officially open and the first $1,000 federal contributions to eligible accounts begin. Any child with a social security number is eligible for an account, which can grow tax deferred for decades. Children born between 2025 and 2028 who are U.S. citizens and have a social security number are eligible for $1,000 in seed money from the federal government. Last point I want to talk about here. Parents, relatives, friends, or employers can collectively contribute up to $5,000 a year to the account. What this essentially is a combination of a retirement account and what we call an UGMA account, Uniform Gift to Minors Act account. Um, Actually, well, just to get a little bit deeper into the legal side of things, under that act, there are technically two accounts. There's the UGMA and UTMA accounts, Uniform Gift to Minors and Uniform Transfer to Minors. So with the uniform gift to minors, then these are tax deferred. Uh, you have to transfer them over, I believe, depending on the state, either 18 or 21 is the limit. And these are tax free accounts when you transfer it, and there are contribution limits. The other one is uniform transfer. Again, there are contribution limits to this one as well. It's also tax free, but it can go up to, I believe, 25 years of age for the child. This doesn't really matter, but sometimes I just like to seem smart, right? Uh, so, anyway, like I said, this is basically a combination of those type of accounts and a retirement account. I think that to some degree, this is a good thing because yes, the $1,000 in seed money does incentivize um, parents to continue to contribute to something that already exists. These are set up automatically for new children, which again, like I said, is a good thing because it incentivizes them to contribute. It's easy to do it, right? The account is already set up. They don't have to do much to get it going, as opposed to setting up an UGMA or an UTMA account, or even a 529 for college accounts, or a Coverdell ESA for high school and college expenses, or whatever other type of account as well for your child. So one of the main benefits, or other main benefits I should say, is that even if the parents don't touch this money at all, this $1,000, it over the course of 65, 70 years of the child's life, in compounded interest, is going to put them in a great position. Granted, this is not going to be all that they need. Let me actually see how much this is going to be real quick. Compound interest calculator, we'll say 7%. So $1,000 in this account for 65 years, at an estimated 7% return, stock market S&P that 500, that is, typically returns between 7 to 10% year over year. So just that $1,000 by the time they're 65 is going to turn into 81,000, just over $81,000. So inflation adjusted, of course, this is going to be somewhere between a year's worth of expenses at that time, more than likely. But that's still a little bit there to help out these kids. A major issue with this, or complaint that you're going to get, of course, is that people are going to simply say, well, number one, why is it only for kids now? I didn't get this. That's a problem. Why should they benefit from something I didn't have? And then number two, which I think is actually a bit more of a relevant complaint, is, well, giving these people free money is of course going to spike inflation. So
Right.
with that in mind, I think there's a larger conversation to be had around where exactly is this money coming from, how it affects the M1 money supply. Are we going to have another situation like similar to COVID, where now all this new money is flooding the market, or flooding the economy, and inflation is going to skyrocket? Well, my personal opinion is that that's not really going to happen. Sure, this is going to show up as a line item in Congress's budget, but at the end of the day, this money is meant to be a retirement account, and I actually believe that I don't remember for sure, um, but I believe if you try to draw the funds before they turn 18 or something like that, then the money goes away, right? You
Right.
lose the $1,000 in seed money. So with that in mind, we essentially have deferred the cost of this for at least 18 years. And on
Mhm.
top of that, because this money is directly being put into an ETF, I believe an S&P 500 ETF, we're actually stimulating the economy in a different way. We're not necessarily just handing out money or giving it to businesses, because these most of these transfers, rather these purchases of stock, are going to happen on the open market. What we've essentially done is created another wealth transfer to institutions and retirees who are now looking to sell those funds. That's my actual complaint, is that we're not actually giving the children free money. We're giving massive institutions and retirees free money. That's my
Right.
actual issue, because all these purchases, are going to cause the demand to rise, which means that stock price is going to rise, and these guys are going to be able to sell for a premium.
Right. Yeah, no, that's kind of what I was thinking after reading the article myself and really thinking about this issue. Is okay, well, what happens when you all of a sudden have a bunch of new entrants into the stock market who weren't there before, who weren't going to be there before, and they are incentivized to go into the stock market because again of that seed money. Well, obviously, stock prices are going to rise tremendously. And in this case, the federal government's, or rather the Treasury's preferred index is the S&P 500, as it states in the article. The default, they are going to open other avenues as well, but the default will be an S&P 500 ETF. Um, so, the S&P 500, we may see just skyrockets, and we know exactly why. Uh, I want to, and so I wanted to go ahead and give validity to that complaint, real quick, Nyanki. That yeah, I think that this could be a bad thing in terms of okay, well, you're just going to incentivize the people who are already in the stock market to sell their stock at record highs. Um, and now all of a sudden you have a situation where the people investing in the Trump accounts have no money, or the value of their accounts go down because all the people who were invested before just sold it off, and and now all of a sudden there's a bunch of outstanding shares on the market that weren't there before, and or rather free shares on the market that weren't there before. And but I do want to take this story um, as a chance to bring up financial literacy. So the Treasury had also announced to the Wall Street Journal. This is I the Wall Street Journal had, I guess they had exclusive access to this. Um, because of their relationship with the Treasury and the financial markets. Um, they the Treasury did say also that parents who sign their kids up for Trump accounts, and even parents who don't, are going to have access to new financial literacy workshops, workbooks, and other literary works as well with the Trump accounts, and also just for general knowledge as well, which I thought was a good strategy moving forward. I think that's a good initiative. That there are a lot of people in the United States who don't know the value of they don't know the value of saving their money, or or doing their best to manage their money, building budgets and things of that nature. And a lot of the times it's not even their fault. Look, I went through a quote unquote financial literacy class in high school too. Same thing in college, and they didn't really teach me much. Thank God for my accounting teacher in high school who did his own financial literacy uh, uh, curriculum on top of the, again, air quote, financial literacy workshop that my high school was required to teach. He had his own workshop, and thank God for that, because he taught us about taxes. He taught us about building budgets, making sure that you know where your dollars are going, your hard-earned dollars, and making sure that nothing is slipping through the cracks. Because if you pay it to if as the old saying goes, pay attention to your pennies and your dollars will take care of themselves. And so I get it. I understand why people aren't educated on financial literacy. And I wouldn't either, except I had incredible teachers and incredible professors. Um, That being said, I think that it's a good thing that the Treasury kind of understands that with the rollout of these Trump accounts and says, you know what, I think it's a good idea that we come out with some material to try to help parents who are potential investors into the Trump accounts. And even people who are just investing in retirement accounts, give them literature, give them, some basic financial literacy, and let's try and teach people good habits early. I think that there are a lot of good things with that. I think that a lot of people lack financial literacy, and that's again a circumstance of our poor education on the topic. There's no other way to say it. Um, but also because people don't really think about it too much. They think that, oh, well, Social Security is going to be there for me when I get older. So what's the point? This program is kind of it's also a little bit of a silent admission, at least to me. They may not have meant it this way, but with how the narrative around Social Security has been moving along, and of course um, the somewhat slowing of the U.S. population growth, and also the drying up of Social Security funds in general, because our government has a spending problem. Uh, this is kind of a silent admission that, hey, Social Security may not be there for your kids. So just in case it just goes away, here's an investment account. Here is how people did it before Social Security was even a thing. And excuse me, this is, and by the way, it'll suit you much better as you did that little calculation, between 7 and 10% year over year. You you know you you know that's just investing 1,000. But imagine if parents and relatives were able to invest $1,000 a year for those 18 years. $18,000 over the life. uh, and you would say, oh, just multiply that number by 18. Well, that's not true, because you're earning compounding interest. And so, it's an exciting time. I think it's an exciting idea. But I'm most excited about the potential for further financial literacy within the population. And again, and again, we should take it as a reminder that, hey, it's time for us to start worrying about retirement. Worry about it early so you're not regretting it later. Make sure you know where your dollars are going. Build your budgets. Be financially literate, because it will suit you better in the long run. So we'll wait and see what happens. Hopefully, it's all good stuff.
Yeah, I mean, completely agree with pretty much everything you said, especially towards the end there. Yes, it is a good thing that these resources are being made available. I'm kind of like you. When I was in high school, I had to go through a financial literacy course as well, and
Hmm.
to be honest, just like you said, the course material was not up to par by any means. Um, Although, to be fair, I have somewhat of a different perspective than most people will, because I was 12 years old, interested in the stock market, and that tells you a little bit about how much of a nerd I am and for how long. So, I mean, everything that they taught in the personal finance course, I knew probably 3 or 4 times as much as that. By the time I was, 16 years old in high school, going through this class. Um, so with that in mind, though, there is still a little bit of a downside to this. Yes, the materials are available, the information is out there, and it's being provided, but the people still have to choose to consume that material.
Right.
They still have to read the guides, they still have to watch the videos, And even if they do that, they still have to act on this information as well. And I think that's ultimately the biggest issue is that there are a lot of people right now that feel trapped as if they don't have a way out, and no amount of information is going to get rid of that feeling, right? Um, this is why, you know, GLP-1s and things like that are so popular because people feel they don't have the self control or the discipline to be able to make some of these changes, and so they look
Right.
for shortcuts and ways to do it. And when it comes to personal finance, there is no shortcut. So, unless you just decide to go, rob a bank or something, which is going to land you in jail,
Right.
there's no way to get rich quick. You're 99% of the people that go to Vegas hoping to hit it big are not going to do so. I mean, to be completely honest with you, it's probably, a lot closer to 99.9% or more are not going to hit it big in Vegas. So the idea that you can just fall into money is not realistic. The idea that you can just read your way out of the deficit that you're in, read your way to prosperity is not the case. There has to be both knowledge and action. And that's what we're trying to teach. We're trying to teach the knowledge on this podcast, but also encourage people to take the action. So of course, consuming this type of content is the first step to getting where you need to go. And so again, I'm very appreciative to everyone who watches. And I hope that you continue to better yourselves and your situations, whatever that may be. And of course, I hope that the people whose children are in these accounts or have these accounts are going to be able to take advantage of those resources as well. The final thing that I'm going to say is about Social Security, because I feel very strongly about Social Security. The biggest issue that I have with Social Security is simply the fact that the federal government that was supposed to be a steward of this money has done a terrible job over the last 80 years, approximately since Social Security was introduced. Actually, I take it back. Social Security was introduced back around the Great Depression, actually.
Yeah.
So
So
we're
it's been 90.
yeah, that's what I was about to say. Yeah, it's been 90 years. Um, anyway, with that in mind, the as you kind of skimmed over, the federal government has used Social Security funds as a second wallet, basically. The idea behind Social Security is that, of course, there are older individuals that don't have retirement funds, and my opinion is that at least today, maybe you have an argument back then, but at least today there is enough knowledge, information, and opportunity that is freely available that there should not be an excuse of well, I didn't know I was supposed to save and invest my money. That's no longer an excuse. But back then you can make the argument that it was an excuse and say, okay, fine, we need to support those people, or we should support those people. And so the younger individuals who are currently working, we're going to pay into this system to basically front load the payouts for the older individuals. As those people died off, they were not supposed to receive the total amount of money that was paid into the system, right? So the ones who started actually paying into the system now still have some funds available. New people come into the system, they're going to get, a little bit more of the advantage. And eventually we're going to get to a point where the person who pays into the system now has complete access to the money that they paid in as well as its growth. Well, the issue is that number one, the federal government didn't actually invest that money into the stock market, because if they did, then there would be, literally hundreds of thousands, if not millions of dollars in each individual account for a person. Number two,
Right.
they didn't really have those individual accounts for people. So, you know, Johnny puts in, say, $100,000 into Social Security over the course of his working life. Well, the federal government doesn't know Johnny's money from Tom's money. That's
Right.
another issue. And then the second thing is, of course, they've been rating this Social Security fund like a second piggy bank literally for decades. Those three things are ultimately the reason why Social Security has failed as a system. So, although the government does have systems in place and, of course, is creating new systems to attempt to make things easier on people in the future, the ultimate lesson is that you and I, all of our listeners, all of our watchers, and every other American, every other person should not rely on the government to provide for you what you need to survive. Because I kind of hate to say this, but generally the government does a bad job of everything.
Right.
So if you are gonna if you're we're 24, 25 years old, right, and even people up to say 35, if you're gonna rely on Social Security to take care of your retirement, you should very quickly get some other plans and start implementing them, because unfortunately it's looking like that's not going to be a very a very good option. I'll just put it that way.
Absolutely. Yeah, and increasingly so. It's sad to watch, but you know, it is what it is. And I think what Social Security has taught us in the last 90 years is that you simply cannot trust that other people who do not know you, and who do not care about and do not care about the level of care that you get, because it's not only not for them, it's not their money. You cannot rely on these people, whether they be the government, whether they be some dude across the country, or some person across town. You cannot rely on them to take care of you. It just that's just a little tidbit of advice for people. And I think Social Security has taught us that it's been used as a second piggy bank, and it's the funds have dried up. We refer to that. We refer to a system like Social Security, by the way, as a Ponzi scheme, and which
I didn't
it
want to say
and
it, but yes.
in in which it takes it in order for the scheme to continue, in order for the people who have already paid into the system to get paid, the scheme must attract more people than have already paid to invest in said system, and the cycle continues. And when that stops, the whole system fails. That is what is called a Ponzi scheme. That is quite literally what Jordan Belfort uh, got thrown in prison for. That's what Bernie Madoff got thrown in prison um, for Ponzi schemes. In other words, fraud. And that is unfortunately legal as long as the government is the one doing the fraud. But anyway, that wraps up today's episode of Road to Riches. If there is one major takeaway from today's stories, it is that the macroeconomic landscape is shifting right under our feet. Between skyrocketing bond yields, a new era at the Federal Reserve, and a new tax advantaged tool hitting the App Store, staying informed is the best way to protect and grow your money. We want to thank you all for tuning in as we navigated these economic headlines together. Make sure you hit that subscribe button so you never miss an episode, and comment your thoughts, because we do read them, and we are so incredibly thankful for them. Until next time, my name is Matthew White, my co-host Nyampu Buchanan, and keep your investments smart, stay focused on the road ahead. Thank you so much.